accounting for long-term assets. What are some long-term assets? Well, we've talked about a few, right? We've talked about plant, property, and equipment is generally what we're thinking of, right? So buildings, land, equipment, machinery, cars, anything that we can use over a year is going to be classified as a long-term asset. This will also be investments. It's a very big category. And so like stocks, bonds, there's a lot here. I think what we're going to be predominantly talking about here is depreciable assets or plant, property, and equipment. So some key terms to reiterate and make sure at the end of this you know. Cost principle. So remember, long-term assets change in value over time. Some go up in value, like land and buildings generally. Some go down in value, and some are volatile. We always record an asset at its cost. That's called the cost principle. So whatever we paid for it is what's going to be on our books. And then long-term assets, we generally depreciate these long-term plant, property, and equipment. There's multiple depreciation methods we can use. We talked about in chapter 1 through 4, the straight line method. This is an easy, simple method where you just take the balance, the cost that we paid for the asset minus its salvage value. And then that difference you amortize or you depreciate over its useful life, right? That useful life being determined either it could be 1 year, 2 years, 3 years, 4 years, 5 years, generally given to you in the answer, but the company would determine the useful life as a policy. Today, we're going to be going over a few other methods of depreciation. This includes units of production and the declining balance methods. So straight line isn't the only method you can use. A lot of companies do. I think most of my clients use straight line method for depreciation, but there's other methods of depreciation too and other benefits to those methods, so we can discuss that. And then we're also going to be talking about the gain or loss on disposal of assets. So again, this is all going into the cycle of recognition and accounting. We have our initial recognition, which is the cost. We will book what the cost of the asset is on our books, generally a pretty easy journal entry. Debit the asset, credit cash or liabilities. Then depreciation methods, that's the subsequent recognition, which is we're going to be debiting our depreciation expense and crediting our accumulated amortization. We've gone over the journal entry, now we're just going to go over some more calculations. And finally, the derecognition or the gain or loss. So when we dispose of an asset, what is the final journal entry? Dispose or sell an asset. So plant assets, tangible in nature, actively used in operations, expected features, future benefit, and generally called plant, property, and equipment. Predominantly what we're going to be focusing on today. And so tangible in nature, actively used in operations, expected to benefit future periods. So buildings, equipment, just know this definition. If we don't have one of these hit, then generally it's not going to be considered plant, property, and equipment. So tangible asset, right? Tangible in nature. So if we have software or intangible products, oh, I see a few people popping in the chat, so let me see the chat. Oh, sorry. Let me stop sharing my screen right now. Okay, how do I do this? Okay, test question. Okay, yeah, test, sorry to interrupt my lecture. Test is most likely going to be online and we're gonna go over in the next class. I'll find out exactly what it's gonna be before we talk about in your class, so don't worry about that. Expect that the rest of this class will be remote. I'd love to see you all. I miss seeing you all. It's been fun having our classes together, but online, I think this is gonna be great. So advantages to both. Especially not commuting on a Saturday for you all. I'm sure you're happy not to go to the school. So screen 2, let's go back to this. So plant assets, why does it have to be tangible in nature? Tangible in nature, we're talking about, if we're talking about like software, or if someone owns something intangible like a license or owns a intellectual property, right? That's not going to be considered plant, property, and equipment. That's going to have different accounting recognition, actually quite complex accounting recognition principles that we're not going to go into in this class. We're just going to talk about tangible in nature and then briefly cover intangibles later. Actively used in operations. So if we have something that we aren't using, we have to consider if we're not using the asset, we can't have it on our books, and that's its own policy. Expected to benefit future periods. If we don't expect any benefit from it, we have to impair the asset, especially if we're not planning on selling it and there's no real value to it. And then if it hits all three of these, then we can call it plant, property, and equipment. So know this definition, it is important. Plant assets. So we've talked about this. Acquisition, we compute the costs. We're going to allocate the cost and treat subsequent expenditures and then record the sale. So through the process, what's considered the cost? There's a few pieces that are considered the cost, right? So we have the purchase price, but normally with large assets, there's reasonable expenditures necessary to get that asset up to use. So a good way to think of this, I think cars are easy for everyone to get, especially in California, where most people drive or have driven. To buy a car, normally you have the purchase price on the car, but then you might also have taxes and fees related to the car, registration costs, and then you might need to do some repairs. If you ever bought a car off Craigslist or a used car, you may need to get new tires, you may need to get fix up the engine and do some significant repairs before that car is actually operational, right? And so in that case, any expenditure needed to get the asset up to use, to get that car drivable, will be capitalized or included in the cost of the car. And so we cannot expense those. And that's something that I've seen a lot of companies mess up, even professional companies. So that's something very valuable to remember is all those costs before the asset is actually usable are capitalizable, which means that it is going to be part of the asset. So if we have repair costs or engineering costs or machine shop charges that we get an invoice for, we shouldn't just assume that they're expensed. We should ask, well, did any of these relate to bringing an asset to usable condition or to prepare the asset for intended use? And if the answer is yes, then it will increase the asset's value. So an example for machinery and equipment generally include taxes. This can include registration fees, transportation charges that ship to us, insurance, installing, assembling, and testing it, and the purchase price. So a lot of pieces of the machinery can be included. Buildings, we might have title fees, attorney fees, taxes, brokerage fees, cost of construction. Land improvements might be paving a driveway, building a fence, cutting shrubs, building lighting systems, and then land improvements themselves are actually depreciated over the useful life of the expected useful life of the improvements. Land is something interesting because land we consider don't depreciate. Land isn't depreciable. So we'll talk about land itself a little separately, but we'll include in the cost of the building. And then land costs include property, survey, title, real estate commissions, purchase price, and title insurance. And the land is not depreciable. So take in mind though, this is all before it's ready for use. So some of these pieces after, we'll still be charged property taxes after the land is available for use or usable, but then afterwards, those will be expenses. So it's all the timing of when we put the asset into use is really key here. And that'll be in your questions. I can also see an easy trick question where we ask what depreciation expense on land is and give you a lot of fact patterns, but then remembering that land is not depreciable. We expect land to last indefinitely. And so here's a good example of lump sum purchase and how we apportion costs. So this can be this is relatively complex, but we have, let's say we purchased land, building, and land improvements. So I bought a building that I want to run my office out of, and we paid $90,000 to acquire the building, the land itself, and fences and shrubs and everything that came on the land. This is probably 100 years ago for this price, but that's okay. Or we're in Ohio somewhere. So we paid $90,000. Well, we have to allocate the value of the land, the value of the bundle purchase to each of the assets, the building, the land, and the land improvements. Each of these assets are going to be disclosed separately on the financial statements. It's all going to be in plant, property, and equipment, but then there'll be a disclosure stating what's in that plant, property, and equipment. And so generally we'll receive appraisal reports saying the building's worth $60,000, the land's worth $30,000, and the land improvements are worth $10,000. So the appraised value is 100,000. We got it on sale. We got it for 90,000. But we have to allocate the $90,000 we paid based on the fair value or the appraised value of the assets. And so I can see you getting appraised values. You'll have to determine the percent. So this percent is 60,000 divided by 100,000 is your 60%, 30 by 100 is 30, 10 by 10 is 10%. And then you multiply it by your 90,000. So 90,000 times 60%, which we determine here, is your 54, 36, and 9,000. And then this will be your final journal entry, the apportioned cost, which is really just our allocated cost based on the relative fair market values. Depreciation is the process of allocating the cost of the equipment over the periods where they're benefiting. So the reason we have depreciation is because of the matching principle. Again, we assume that we buy an asset to help us generate revenue, otherwise we wouldn't purchase it. The whole purpose of a business is to generate revenue in the first place. And then we depreciate that asset over the period we expect it to provide revenue to us. So balance sheet is our acquisition cost, and then we allocate it as an expense to the income statement as we depreciate. We've talked about the straight line method in detail before, right? Straight line method is just debit, depreciation, expense, credit, accumulated depreciation. Journal entries are going to be the same, but straight line is simple. It's just equally over the term of the asset less the salvage value. But units of production and declining balance are a little more complex. We're going to go into that today. So factors in computing depreciation. Always going to need to know this: cost, salvage value, useful life. Cost is what we paid for the asset. So let's say we bought a building for 100,000. It's just a building. Our cost is 100,000. Let's say we assume that the ending value of the building, the salvage value, if we sold it for scrap parts, is 10,000. Then our residual value is 90,000. And then the useful life we could say is 5 years. And then we depreciate the $90,000 over the 5 years. Always write down these variables when you're doing a depreciation question. Make sure you know your cost, your salvage value, your depreciable cost, also your residual cost. The 10,000 minus the 1,000 is the 9,000, which is the depreciable cost. Cost minus salvage value is depreciable cost. In useful life, we have the accounting periods, 5 years. And then we might have units here. So cost minus salvage value over estimated useful life is depreciation expense over for the straight line method. You'll have to memorize the formulas for each method. Straight line method, relatively simple. I'm not going to stay here too long because we've done it before. So cost minus salvage value, 9,000 divided by the 5 years, 1,800 per year. And then we'll just debit depreciation expense, credit accumulated depreciation. We had this on the exam. Some students there was a trick question there because it was for part of the year. So remember, if we get this in June or July, you have to account for the amount of months left or the amount of days left in the year and then allocate accordingly. So if this was half a year of depreciation, it'd be 900 for the first year and 1,800 for the subsequent years. So the depreciation expense is always going to be even on the income statement, and the book value will decline evenly. Understanding how the depreciation methods impact the balance sheet and income statement from a variable perspective, from a mathematic perspective, is very important. So make sure, if I ask on the exam, which depreciation expense method has an even recognition pattern on the income statement, I'd expect you to say the straight line method, because it's even on the income statement, even here. And then if we said if there's an even method of decline on the asset on the balance sheet, we'd say the straight line method. And then remember, accumulated depreciation was the first contra asset account we saw. It reduces the plant, property, and equipment value, and so our net plant, property, and equipment will be the 6,400 on our financial statements. Again, accumulated depreciation has a normal balance of a credit, machinery has a normal balance of a debit, and both are asset accounts. Accumulated depreciation is just a contra asset as it reduces the value of the asset machinery. And then here's a good example of a schedule. So 10,000 end value, depreciation 9,000. This is depreciable cost, 20%. Well, that's 1 divided by 5 is 20. And then we get an expense of 1,800, end of the period amortization. Accumulated amortization is 1,800. This is their book value. And as we see, the accumulated amortization goes up by the expense, the book value goes down. I know these tables might seem a little confusing, but you have to get to know them because all of our long-term assets and long-term liabilities going forward are going to have similar tables. So please get familiar with this format. Everything you do in accounting is going to eventually be done in Excel, which pretty much is just this. So please get comfortable with this format and understand the formulas where this times this equals this, accumulated, so this equals this plus this equals 3,600, this plus this plus this equals 5,400, and the end of the book value is just this minus this, this 10,000 minus this 10,000 minus 3,600, and so on and so forth. At the end of the life, we should get back down to the salvage value. Okay, unit of production method. So again, we're going to figure out our depreciable value, which is just cost minus salvage value. And now we're just going to determine it based on units of production. So a good example of, we set as a company, we set the policy on how we're going to depreciate our assets based on asset class. And so asset class might be equipment, it might be the building, the land, etc., but land isn't depreciable. So many companies do straight line because they think that best represents how expenses are recognized. But some companies, namely manufacturing companies who make, let's say, books or shoes, may determine that time isn't the best indicator because their machinery may have a useful life based on the number of shoes or the number of products they expect to produce. And so for some products, think of the warranty for cars might say good for 10 years or 100,000 miles. Well, if you expect to drive that 100,000 miles much quicker than 10 years based on your business model, you may decide to do the number of miles as the depreciation method rather than the years itself. Same thing with shoes. A piece of machinery might state that it can make 1,000 pairs of shoes, 1 million pairs of shoes, or good for 5 years. If you're expecting to make 1 million a year, it might make more sense to use the total units of production. And our depreciation expense is going to be just the depreciation per unit by the number of units produced. So not too complex, same calculation to figure depreciation cost per units, cost minus salvage value over the total units produced. And then we just go for it. So same here, 9,000, 36,000 shoes. So we figure out how much depreciation expense per shoe. We just take the 9,000 divided by the 36,000 shoes. And then if we use 7,000, we determine the depreciation expense by the 9,000 divided by the 36,000 multiplied by the 7,000, which you'll see here. 9,000 divided by the 36,000 equals 25 cents a unit, times the 7,000 is your 1,750. So again, it's relatively simple calculation, just making sure you memorize how to derive it. As you can see, the method here is more sporadic because it mimics exactly how shoes are being produced, and which could be different. So it's not an even form of transfer. And so if I asked you on an exam, what type of method has an unpredictable, what depreciation method has an unpredictable pattern of depreciation expense, you might say units of production. It's unpredictable. And so you can see here, 7,000. Again, we'll just walk through this for the recording. How is this calculated? This is the end book value. We know that our salvage value is actually 9,000. We can't get above that for our accumulated depreciation because we know it's only 9,000. And so then we take our depreciation for the number of units, 7,000 times 25 cents. We got the 25 cents by dividing the total amount of units, 36,000, into the 9,000. So the depreciation expense, 1,750. That's 7,000 times the 25 cents. And then our accumulated depreciation is just the sum going forward. And then our end book value is the 10,000 minus the 1,750, and so on and so forth until we get our 1,000 at the end. The last but not least, the double declining balance method. And so this gives the concept that some assets lose value significantly more quickly over time than other assets. And so a good example might be computers. And so even if we have a 5-year useful life on a computer, like we might use laptops. I'm using my company's laptop, and it was brand new when I received it 3 years ago, and now it went from $2,000 in value to now you can buy it for $500. Laptops generally depreciate extremely quickly in value, right? A lot of computer and technological equipment depreciates quickly. So a company may adopt for its technological equipment the double declining balance method, where you determine the rate to be twice as much as a straight line rate at any given time. This is probably the most complex method. It was on my CPA exam. So the sooner you learn it, the better. You'll be tested on it multiple times through the rest of your accounting equation. One of the reasons this also exists is because it increases your expense in earlier periods. So some small companies who aren't interested in presenting strong financial statements but are more interested in tax deductions may prefer this method, so they take more expense up front. But tax laws are slightly different now, so take that with a caveat. But there might be reasons why companies want to present more expense up front. That's the main reason. Another main reason they might take the double declining method. So let's use the same fact pattern, exact same fact pattern, right? We know all this information. How will we determine it? Well, we know the straight line is 100% divided by the useful life. So we know the straight line is 100% divided by 5 years is 20% a year. For those of you that don't remember, we're on slide 36. We calculated that all the way up here, 20%. The next piece, then we just multiply that percentage by 2. So we're going to take twice the amount of depreciation per year, based on a percentage, not an amount. So the depreciation expense is going to be, for the first year, is going to be 40% times the 10,000, which is 4,000 for the first year. It's important to caveat here, this does not use salvage value in the calculate or the original calculation. So for a straight line, we're doing the 20% times 9,000. Double declining is the 40% times the full book, or the full value, full book value. So that's another difference. So that's 4,000 for the first year. Well, the original straight line was the 20% of the 9,000, the 1,800. So 10,000. The depreciation expense for year 2 also gets more complex. So then we're always going to be taking the double declining rate, that's 40%. That never changes. That's always going to be the same for the rest of the problems for the double declining method. However, that 40% is going to be multiplied by a moving variable, which is going to be the book value. And so that 40% the next year will be 40% times the 10,000 minus the 4,000 lost. So 2,400 the next year. So we're always decreasing this is an exponential decrease method where we're doubling the value and then decreasing it at an exponential rate. So 40% times the 10,000, this is the total book value minus the 4,000 of depreciation up to date to equal the 2,400. And this is our depreciation expense for year 2. So you can see this method, that's how this calculation is formatted. 10,000 times the 40%, we know how we calculate the 40%, that's just 2 times the rate that we had in the straight line method. Always have to calculate the straight line method's rate first, then multiply it by 2. Then we multiply this to get our depreciation expense. The difference here between the straight line and the double declining is the double declining uses the salvage, doesn't use the salvage value, while the straight line uses the salvage value in its multiplication. Then this is our end of period accumulated amortization and our net end book value. Then we're going to take the net end book value and multiply it by the 40%, which is where we get the 2,400. And we continue so on and so forth to continue to calculate the net book value and then multiply it by the 40% until we get to the end. Now what's complex here is in the last year of life, we can never have more depreciation expense than our salvage value. And since the double declining method isn't even, sometimes we will have more depreciation expense. So it's always limited at the salvage value. So at this point, we only have 8,704 left on the asset. So then the end of accumulated depreciation, the end value of the asset on here is 1,296 on year 4. Sorry, 1, 2, 3, 4, year 4, based on our calculations. We know that the salvage value is 1,000. So even though if we recalculate this, 1,296 times 400, right? Open it up here. One, 296 times 0.4, we get 518. But we can't recognize that because that's higher than our salvage value. So we're going to cap it at 296. So we true it down to our salvage value. So this is another trick question that could be asked right? You're going to have to know exactly what's included in the straight line method, the double declining method, and the units of production method. Straight line excludes your salvage value from the original calculation, double declining includes it, right? And then at the end, we have to always calculate every single year in order to determine the last balance here. We can't depreciate more than the salvage value. And so here's the comparison of depreciation methods. First period, straight line, we can see is even. Unit production is sporadic. Double declining starts extremely high and then gets very low towards the end. All for the same fact pattern. And so I expect you all to memorize this. This is a very big piece of your accounting education and will prove how you're able to manipulate the same fact patterns. And so if anyone ever asks you, well, is accounting just, I thought accounting was just adding and subtraction. You can tell them, no, there's 100 different ways to do depreciation. Don't get me started. So there's other methods of depreciation too. We're not going to be covering them too much today. You will get them under your future accounting education. Another rule. Oh, we talked about this. And if too much depreciation is calculated, just use the amount that will reduce the asset to salvage value. Okay, so we're gonna have to keep going. I know this because it's an accelerated course, and this will be the next piece. Let me ask any questions so far. Now there's a lot there, but I promise if you really think about it, we didn't cover too much. I'm on slide 42, but in reality, right, all we talked about was on this one slide. Cost principle, depreciation method. Cost principle is our how we determine the value of acquiring the asset for the original journal entry, where we just debit the asset, credit the cash or liability. And then depreciation expense, we just have straight line, units of production, declining balance, just memorize them. The formulas related to these. And then next we're gonna cover the gain and loss. So overall, not a lot we're covering. There's just formulas you have to memorize. Okay, so I'll go answer questions now. Oh, how do you determine the useful life? That's an accounting policy. So your accounting team will decide the useful life of PP&E based on asset class. And so I help companies with that. We'll determine, and generally you determine based off your competitors or based off your expected life. So for example, a company might say that they have computers and they'll ask me how long they should depreciate it over. I'll look at public companies that are similar online and say, well, you know, you're a software company and Apple depreciates their computers over a 3-year useful life. So I recommend doing something similar unless you plan on using them a lot longer. And if they tell me, oh, well, our computers we do the exact same thing, same operations as Apple, and we expect to use the computers the same length, then I would say a 3-year useful life is appropriate. Same thing. Generally, it's going to be independent of each company, but you can look at the company's competitors as a benchmark and then work with the company to decide if that benchmark is an accurate depiction of how they expect to use their assets. In real life too, then you can look at the company's pattern of disposal. So if a company does sell their laptops or buy new laptops every 3 years, that would help decide that. But again, accounting policy, and you're generally going to have management decide that. Does that help? For your homework, you're not going to be expected to learn how to determine this. We're going to talk about gains and losses next. So we'll go into gains and losses. But if your selling value is greater than, not your salvage value, but your net book value, it'll be considered a gain on your books, which we'll go into. Because sometimes we might sell our assets before they hit their salvage value. Any other questions, team? I'm talking a lot more up here, so could use a break if anyone has a question. Oh, great question. I generally don't see that. No, I generally, you adopt one method for all assets, all asset classes, and then they might have different useful lives. Great question, though. Theoretically, it makes more sense from a consistency standpoint to use the same depreciation method across the boards. I'd be curious, there might be some one-off cases where companies have to specifically disclose different methods for different classes of assets, but I haven't seen it. I don't think that would happen in practice very often, but it may make sense in some circumstances. On the next slide, you'll see, I think close to 85 to 90% of companies straight line. So these other methods are important to know, because I have seen companies that use double declining, but these are pretty one-off circumstances. But take on mind, when I say one-off, that means don't learn it. Most of my clients are those one-off circumstances in these areas of accounting, and that's what gets paid the big bucks, is because so few people know about it. Double declining. Let's see, let me pull it up. Good question, Chi. I think that's true. I'll show you double declining method. If you see here, that's not double declining method. The book value is not the same. End of first year, 10,000, then 6,000, which is reduced by the depreciation. So it's always going to be reduced by the depreciation for the double declining. Does that make sense, Chi? I think I see what you're saying. So let me share and then I'll move forward. This 40% is calculated upfront, always. So we calculate that as twice of the straight line rate. And so no matter what, this 40% will never change. The 10,000, this gets decreased. This is a beginning period book. Oh, we're assuming here, this 10,000 to 10,000, if this is your question, we're assuming this, we bought this on December 31st, and then this is just January 1st. So there's no depreciation that would occur on December 31st to January 1st. Okay, perfect. Okay, let's go back in. We'll be wrapping this one up. Share screen 2. So here's a good chart. I'm not sure when this data was taken. Based on my experience, this seems pretty accurate to me. The vast majority of companies use straight line method. Depreciation for tax reporting. Most corporations use a different system for tax purposes called MACRS. You're not going to learn details of taxes in this class. The taxes is really its own study in accounting. After you learn basic accounting, you can head to audit, you can head into consulting. Audit and consulting are tied pretty close to each other, or you can go into tax. Tax has its own specific laws that really build off of this, and it's much more legal based. So MACRS, just know that it exists, but I'm not expecting you to know anything related to MACRS now. It's much more complex. And so as we build our knowledge, right, we talked in the first period, in the first midterm, we learned about depreciation and doing it for partial years. And now we're going to expect to continue that knowledge and build upon it and do the partial year depreciation, not just for straight line, but for all types of depreciation methods. We've already done this from chapter 1 through 4 though. So if you understood it in chapter 1 through 4, I think you should be fine. We might just make it a little more complex. And that's where all of you are in the class now and have gotten through the first midterm. Generally, you're going to continue to do well as long as you understood that foundation, because we're really just slightly building upon what we originally did and practicing it. So 10,000 minus 1,000. Again, if we had the same fact pattern, but we're just going to do it for 3 months out of the year, we just take 3 months of depreciation for that year. So same fact pattern, but we, instead of putting it in January 1st or December 31st, we're just in October 1st. And so we're just going to take it for 3 months, October, November, December. A question that might be asked is, how do you determine that there's different policies a company can elect for depreciation methods? There's you can elect it over days, you can elect it over months, you can elect it over half months, you can elect it over quarters. That's a company policy decision, and it's not something you have to just worry about. But we'll say it in the question if you didn't depreciate over months or days. I'm seeing a few questions. Let me stop sharing for real quick. Oh yeah, I think we're on the same page. Okay. Yeah, I expect you'll have to know the partial years. And then here's just examples for partial years. So I think that we can walk through this one pretty quickly. We purchased and installed machinery with a total cost of $105,000. That total cost might include the taxes and everything that we talked about at the beginning, and I expect you to be able to calculate that. But that's one piece. Then straight line depreciation is taken for each year for 4 years, assuming no salvage value. So no salvage value, so we don't have to worry about backing anything out of here. This machinery is disposed January 1st or July 1st, 2021, the 5th year of service. So first, we have to figure out what's the value of the machinery at this time, right? Value of machinery, balance of accumulated depreciation, we just take the 105,000 minus the salvage value, which is nothing, divided by 7 times 4 to get our 60,000. 105 is the book value, $0 is the salvage value, 7 years is the useful life. That's 15,000 a year is this calculation times the 4 years it's been in service to determine how much accumulated depreciation we have, 60,000. The book value is 37,500. We have additional 7,500 here for the partial year of July. So this is for the first 4 years, and the fact that we are trying to calculate in July, we also have to take an additional half year. This is a half year journal entry, the 7,500 here. That's 15,000 divided by 2 because we installed it January, but we have to focus on the fact that we dispose of it in July. This gives us an accumulated depreciation of 67,500 based on the machinery of 105,000. That difference is going to be your 37,500. That's going to be considered your net book value as of July 1st, 2021. I expect you to be able to do a calculation like this. Don't be overwhelmed by it. It's everything we've talked about so far. We know how to do straight line depreciation. This is easy for us. We know how to calculate depreciation expense, and we've done partial years. So it shouldn't be, hopefully not too complex at this point. If it is, practice these calculations so you get comfortable with them. Prepare entries to record the partial year. This is just the entry. And we've done this entry many, many times now. Debit depreciation expense, credit accumulated depreciation. Okay, what's the financial statement will you see? Okay, so just curious for what will you actually see on the financial statements? You might have all of these different assets. At the end of the day, it's all going to be in plant, property, and equipment net. And then if it's material, it'll be disclosed in the financial statements. So know that we'll be tracking all of this separately, but at the end of the day, this will be on the balance sheet, the net amount. Net being the subtraction of the gross assets, the original book value, less the accumulated depreciation. Gross meaning total, net being subtracted. Lastly, we're going to talk about gains and losses. This is a lot more simple than you'd think, luckily, as long as we're building off our blocks. So we know that when we receive cash, we get a debit. We know that when we dispose of an asset, we have to credit it. And so the plug, whatever is remaining at the end of the day, the cash that we get, and if it's higher than the net book value of the asset, then we're going to have a gain. And if the cash we receive is less, or the consideration, it can also be accounts receivable, right? If the consideration we receive is less than the cash we receive, then we have a loss. The consideration is less then the net book value is a loss. So think cash, you can think of the consideration too, because it could be accounts receivables. If it's greater than the net book value, you get a gain. If it's less than a net book value, you get a loss. And if it's equal, there's no gain or loss. And you just have to use your T accounts. And then net book value is just what we calculate after all the depreciation to the period we sell it. So net book value, again, is your gross cost that you originally purchased it for, which includes any of those taxes or fees to bring it to useful service, and then less the depreciation, depending on your depreciation method. So if we discard it, let's say that no cash flow is received and we're just throwing an asset away because it was fully used and it's no longer usable. It's just a book reclass. So we have debit accumulated depreciation and credit machinery on our books. So if you think about it on the financial statement itself, there's really going to be no change because this was already going to be presented at zero net. The gross amount would be different, but it's going to be zero net because this machinery was already fully amortized. And then to take it off of the books because we no longer have it, we would debit accumulated depreciation and credit machinery. Accumulated depreciation is a contra asset, right? So it normally has a credit balance. So to take it off the books, we debit it. And the same for machinery. Machinery has a debit balance. Normally it's an asset. So to remove it, we have a credit balance. They calculated this by depreciating it over 8 years. Take in mind, right, that we might have fully depreciated an asset and still have it in use, which is why we might still have it on our books. So we would only do this once we dispose of it. So sometimes we might estimate that an asset was depreciated quicker than it actually was because we kept our laptop for an extra 5 years. That's okay, just keep it on the books. That's fully depreciated value. Just because you're using it doesn't mean that you have to change the facts and circumstances at all. There are changes to estimates, which we'll learn down the road, but you don't have to worry about that right now. And generally, I don't see it that much. So what if we just throw something away and we didn't receive cash for it, and it wasn't fully depreciated? So this example is it's fully depreciated to its salvage value. Here it isn't. So again, we always have to follow the method. We determine the cost, and then we determine the depreciation. This determine depreciation for you. So we're saying 6,000 on December 31st, and then it's asking you. So this question is asking you to determine half a year of depreciation expense, and it's already given you up to December 31st. So you have to figure out the depreciation expense remaining and then do journal entries. So we bring the depreciation up to date for the half year. It's $1,000 a year, right? 8,000, no salvage value, 8 years, $1,000 a year. We're 6 years in. It's asking you to do half a year more. So we debit depreciation expense by 500, 1,000 times a half. And then accumulated depreciation for the equipment, we credit it. And then we have to record the disposal. And so if we haven't fully depreciated the asset, then we're going to debit a loss on disposal. And that's, again, just the plug, right? We know the equipment's worth 8,000. We have to get it off the books, credit the asset to remove it. We have to debit the accumulated depreciation that's remaining. And the difference, we know there has to be a debit because debits have to equal credits. So that debit is going to be the difference. And that if it's a debit, we know debits are expenses, right? So expenses are debits, so it has to be a loss. We're not going to call it expense. A loss is something that happens outside of ordinary activities. So we don't, this won't be presented as part of our net profit. This will be part of our net income because it's not an ordinary business activity. Again, losses will be debits, revenues will be credits, or gains will be credits. And so we've talked about disposals, right? That means we're not receiving cash or consideration for it. And then if we sell it, we receive consideration. It's going to be the exact same type of determination, except now we're just adding cash to the balance, cash to these journal entries. And then the difference is the gain or loss. So on March 31st, we sell equipment that originally cost 16,000, has accumulated depreciation of 12,000. So at this point in time, we have a net book value of 4,000 of the prior quarter, and annual depreciation is 4,000. And we use straight line depreciation, and we sold it for 3,000 cash. And we know that we sold it on March 31st. So we have to update the depreciation for March 31st. So we know we only have a $4,000 net book value. And then we have to also consider 1/3 of this, which is an additional 1,000. That's 4,000 times 3 quarters. I mean, one quarter, or 3 divided by 12. That's the March 31st here. March 31st is the third month of the year. And then that's 16,000 minus 12,000 is 4,000. Then we're going to subtract it by 1,000, right? Depreciation expense is going to be 1,000 because that monthly depreciation expense of 4,000, we're just going to multiply by that 1 quarter. So at the end of the day, our accumulated depreciation is 13,000. Our equipment is 16,000 after this calculation. The 12,000 increases to 13,000. So we debit our accumulated depreciation, we credit our equipment, and we debit our cash. It balances, so we don't have a gain or loss in this situation. And you can imagine it's actually relatively simple going forward. If we have more cash in the situation, if we had $4,000, receive 4,000, we'd have a gain of 1,000. If we receive 2,000, we'd have a loss of 1,000. So it's just the difference is going to be the plug. And that's going to be how we make our journal entries. So similar fact pattern. We're going to, I'm not going to go over this in detail, so everyone has some time. The exact same, very similar fact pattern, except we received more cash. Everything's the same except we received more cash. And so in this situation, we received more cash, and that difference is going to be a $4,000 gain because we received more cash. Same fact pattern here, except we received less cash. The difference will be a loss of 500. Those losses and gains will be under gross profit as part of your other expenses or other income. Okay, don't worry about group projects. We can't do that right now, but if you want to work as a group, you can always reach out to me in the future if you have questions related to this. I recommend just practicing these and making sure you understand the whole process. At the end of the day, it's that one slide. There's not a lot there, as long as you understand the depreciation method and the fact that the debits and credits are equaling at the end. Depreciation, we talked about this. And then finally, this is ordinary repairs or capital expenditures. So if the idea is if we're trying to fix an asset that actually increases the value of an asset, we should capitalize it. This is pretty rare. You normally expense it. So the thought here is after we set up an asset and have capitalized all the setup expenses, any future maintenance, let's say for the car, you take the car and you get the oil change, you're going to expense it. But if there's something that you do that's an extreme overhaul to extend the useful life of the asset, we might change these estimates. And so the idea of that would be, let's say I've had my car for 10 years. I originally purchased it. I've been getting oil changes, but I decide, you know what, I'm going to do a full overhaul on the car. I'm going to change the engine, I'm going to change the speaker system. I'm going to do something that is going to make this car last another 10 years, change everything inside of it. Then that will be considered a major overhaul, and we're going to extend the life of the original estimate. And so we might revise our original estimates. I'm not asking you to figure out how to do the revisions. I'm just asking you to understand this. Ordinary repairs are going to be income statement and treated as an expense. And then if it's a capital expenditure, if it's something that really improves the asset over a long time and very clearly improves it, we're going to increase it, treat it as an asset and increase the value of the asset in the useful life. Most of the time, we don't see this. This is pretty rare because any capital expenditures are generally immaterial. Just know this chart, but I don't expect you to do journal entries for capitalization of extraordinary capital expenditures. So that kind of wraps up the two chapters that we've talked about, accounts receivable, and we've talked about long-term assets. What I'm really expecting here for long-term assets is really on this slide, right? At that summary slide I have right here, the key terms. Know your cost principle, know how to what to bring it up to cost. So I might give you an example of, I bought a car, there was title expense for the car. We bought the car January, let's say we bought the car the 21st. Then on the 22nd, on the 21st, I paid taxes for it. 22nd, it needed an engine, and it needed to be shipped to my house. And the shipment cost $100. The engine cost another $3,000 or shipped to my business. And 23, I paid a shipping and handling fee for it. the truck driver dropped it off. 24, I get the car, and then the 31st, I gave it an oil change for $100. I expect you to know like everything before the 24th, before it was ready for service and be usable, should be included in the cost of the asset, but anything subsequent, this should be expensed. That's the cost principle, and everything should be based at historic cost, what we paid for it. Then I expect you to know the depreciation methods from the beginning to the end, be able to know straight line units of production and double declining balance, know which ones include salvage value, which ones don't, and then be able to determine any given year and half years and partial periods for the depreciation expense. And then after all of that, be able to figure out the gain and loss on disposal of an asset. So know that I could test all of this in one question, right? Or you could be tested. If I ask you to determine a gain or loss on an asset, it might include figuring out the cost and then figuring out the depreciation in order to get the correct amount. Again, recommend on tests and quizzes that when you have to determine this information, and if you get one of these very long problems, save these problems for the end so you don't get overwhelmed by them, especially if I ask you to calculate a gain or loss, and then you have to go through the cost and all the depreciation. It can feel a little overwhelming. So these would be one of the good questions to say for the end. And I'm sure as you go through an exam or through the work, you might remember, oh, okay, this is how I do straight line. Okay, I remember there's this funky thing about cost, and then feel more confident towards the end. I taught students who were doing this method that I taught on the exam, and they tended to do better. The students I saw who scanned through and tried to solve the easy ones quickly and then work on the more difficult ones at the end seemed less stressed and did overall better on the exam. And I've seen that with multiple classes. So overall, that's accounts receivable and long-term assets. That's going to get you through spring break. So please review these slides over spring break and these recordings that I'll send out. If you have any more questions, I'll either make more videos. I'm happy to make videos, or I'm happy to send you videos related to this matter. And if you need time for office hours, you can schedule them before or after my lectures by just sending me an email beforehand, and we'll have a one-on-one Zoom, or we could do it with other students in the class. I encourage you all to still continue to work with each other. If you have any questions, now that you have Zoom, you can work with each other. And normally this piece of technology is actually quite expensive, but the school purchased it, so highly recommend using it. I actually use this piece of technology for all my clients, so getting familiar with this technology is going to be great for your future careers. I also wanted to caveat too, before I open up for questions, I'm sure this is a very intense time for a lot of people with the coronavirus. Please be aware that the school has resources, that we have financial aid. So please, I've sent everyone a book at the beginning of the semester regarding FAFSA. So please don't feel alone. If you're going through financial difficulty, please look at the guide. I gave my book for free to everyone here. And then there's counselors at the school too who can assist. And for this class, do your best. I think that we're doing our best to make it as accessible to everybody as possible with the recordings and with these videos. I'm really impressed with how the school's responded so quickly. And I want everyone here to know that this is probably the best time that you could get educated. And so anytime that a recession might start or there's any shocks to the market, this is definitely a shock. If you study economics, we learn all about these in economics. And I'll hopefully be teaching that in the upcoming semester, so hopefully you can take it with me. But when these shocks occur, one of the best things you can do for yourself and your futures is to study and get degrees and retool. And currently I'm taking my MBA just because I know these are the best times to retool for the future market. So don't be discouraged and see this as an opportunity, hopefully. So I'll open up to questions and we'll go from there. Yeah, happy to. So does anyone have any questions related to the material? I'm also happy to talk about news, like if anyone's curious about the market or how this is affecting accounting in general, what I'm seeing. But otherwise, the one thing I do want to note too is, I used to be a bartender, I used to be a server. I've worked all kinds of jobs. I've been a bar back, busboy. I've worked since I was 16. And one of the most important things I ever did was continue my education. So I know this is a difficult course, but unfortunately, a lot of my friends that I'm still very close to are struggling with this market. I think that the market will recover as soon as this all blows over. But seeing the people who were able to finish their education, are able to focus on it despite any hardships they're going through, are having an easier go of it currently. So I'm really proud of everyone in this class. I'm glad you're still sticking it out, and I really encourage trying to do your best to take advantage of this time because it's just going to lead to a much more secure future for you all. So I'm really glad you're all taking the time here, and I want to encourage you that if you need anything, feel free to reach out to me, and I'll do my best to make time for you. Any other questions? Okay, I expect you'll all be depreciation experts now, and I'll stop the class early. If anyone wants my office hours, feel free to reach out to me or send me a text right now or over the chat, and I can meet with you one-on-one. Yep. Have a great weekend, everybody. Enjoy your spring break, and please just make sure you have your homework done, and don't just not do accounting for 2 weeks. I don't want you to get rusty. Of course.